now to kickstart our first session, we have Mr. Jesper Palmqvist, Regional Vice President, Asia Pacific STR CoStar Group, to give us his strategic insights on the industry. From the regional headquarters of Singapore, he leads the company and regional team in sales, strategy, and development for the wider region. He has more than 20 years of experience across hospitality, online, and IT. Please give a round of applause for Jesper.
Good morning. Om Swastiastu, Selamat pagi, good morning. Thank you, especially to you who set your alarm clock in the right time zone and you made it. Listen, whoever is not in the room and they might drip feed in, they can catch up later, fine, but they don't get the credit that you guys get. I really appreciate it. You get up in the morning. Listen, I had to change the title of my presentation, and yes, I asked some of you, like, what do you want to know about and talk about? Bali is special because we can come here and talk about many different things. I was in Phuket on Monday, great sustainability event, but people don't come here for this kind of event. So I think that's something about Bali. But everyone I've been speaking to in the last week about Indonesia has just been, it's the end of the world, it's the end of time. So let's see how we break that down. And I don't know about you, I can only speak for myself, but sometimes it starts to feel a little bit tight around here. Okay, just me? Fine, don't be honest. That's kind of the theme that I always, when I keep looking at all these different markets, but around the world, when you look at this old chart with just occupancy growth, it doesn't matter if you're out west or if in Asia Pacific, it's low numbers in growth year to date in 25. When I was here last year in a different ballroom, we talked about this the same way. It's going to be tighter, so don't expect magical big results. Same thing on rates, and then you see like China there, of course, and then the 7%, a few markets that still, Japan, who was still growing a little bit, but that has slowed down. So overall, tightness, not the big growth numbers that we've been seeing in a few years. There we go. So I thought I'd start with just walking through some of the Asia Pacific markets, a bit of a snapshot. I've never put Australia, Korea, and Vietnam in the same graph, on the same slide. They don't have too much to do with each other. I put them together because they are three markets that have stable growth. That's nice. I want to start on a high note. These are markets that have, for various reasons, in the last few years, actually looking not too bad. Vietnam is about the regional markets that still have some runway. Now, this is going to slow down towards the end of the year and into 26, fine. And Ho Chi Minh and Hanoi already had some, so that's already started to slow down. But it's a market that people will see coming back strongly and with a moderate growth. Australia, that's not massive growth, it's not a huge, but why do people invest in it? Because it's predictable, it's stable, people like it, it's in capitals, it's in regional markets, leisure and business. Australia performs well, full stop, and it will continue to do so with limited growth. But I'm more interested in Korea. Talk more about Korea in the last year and the last few months that I have in the past. We always knew money was coming out of Korea, say buying office assets in London from the pension fund, etc. More people are investing in Korea now, liking. It has the same opportunities and challenges as in the past. If it was how your financing is done, how do you work with the unions, whatever it is. But now they have more brands, more hotels, a bigger offering around the country. It's interesting. So as the occupancy is kind of slowed down, it has seen significant rate growth in the last few years. Market composition, yes, you have more high-end hotels that have come, but more people are looking across the country in Korea to add to their portfolio than before. It has obviously a potential volatility with demand from the big neighbor out west in the back burner. So I choose just a couple of markets to look at emerging, if you call them that, where there still is going to take a little bit longer in volatility. And I think for Philippines, what concerns me there is that we've sat there at 60-65% occupancy for 12 to 18 months. Department of Tourism, we're not seeing big inbound travel increasing, and domestic is not working too high as well. We got high construction costs when you're outside the Manila area for everything. So I think that's going to take time. Now the rates, that's ADR there, holding up a little bit, total RevPAR flat. So it's the rates really helping Philippines there. Sri Lanka, it has stalled. We know that demand is an issue because of flights, and we're missing flights, and they're expensive. But you also have new hotels that have brought up higher rates, and that's something the country was missing for a while. But this is going to take time, and it'll take even longer in a market like Cambodia, because you have this strong occupancy growth from a low base, but at least the rates stopped falling, because that was going on for quite a long time, and at least now the stop loss is incurred, and now it comes back. It's a beautiful country, but this is going to take a little bit longer. So similar but different stories across these markets. And then you look in the Indian Ocean, the islands. People like to invest in resorts. We've seen that in the last 5 to 10 years for sure. And if I call out Maldives, we saw about 12 to 18 months, it was 2-3% negative growth. People get a little bit worried. Where's the demand shifting to? But you had rate stability for 3 years, and you've added like 25 resorts from 160 to 180. By the end of this decade, we're looking at 200 resorts. It wasn't that long ago, it was 120. Seems the Maldives can take on a lot of resorts and be strong for the future. So it's hard not to be reasonably bullish for Maldives to continue to be strong as well. And then move into, bifurcation. Let's talk about trifurcation. 3 is better than 2. I think that's a cool word. I don't know if it exists. Can you say trifurcation? Japan, India, and China are extremely large markets that deserve a session on its own, but we don't have time, so just a couple of bullet points. When the Japanese growth that we've all seen, we said last year it's going to slow down first half of the year. It did, maybe a bit more gradual than we thought. So the second half of the year still has some, but it's more into 26 where we really see that both regional and second-tier markets and the big 3 or big 4 coming down. I mean, weekend rates are crazy. Like, you pay 20% higher on weekends. So if you stay home there, you save money, but on the weekdays, there's moving a little bit easier. So that has started to slow down at the end there, as you can see. India is a market where you had 2-3 years of really strong growth. And what's exciting is, of course, that it's regional. So don't look at the Mumbai and Delhi numbers, etc., Bangalore, and expect that. It's about all that. That's why Manav is successful in having the 𝐏𝐸𝐈 conference. Everyone's coming there who wants new brands, wants to invest and grow in India for sure. And a lot of new supply will put pressure on occasion. Let's not talk too much about China, but it remains really tight, right? The spending, regardless of how much fun he has with his friends in Beijing at the moment, the leadership, it is tight in terms of spending and what people are doing, and the housing bubble. You can buy a flat really cheap in China if you want right now. But I thought by Q3 we'd start to see more tier 1 and new first-tier cities to turn around. It's slow. It stopped at least the rate negative growth, and it's moving slowly upwards, but it feels more at 2016 where we can see some rebound. So that's the rate decline that you've seen in overall in mainland China particularly. And then you have the stalling countries, if you look at Singapore, Thailand, and Malaysia. And I say stalling there, but we'll talk about Thailand in a second at the end. You see that little line dropping down. But basically, you have a market like Singapore where it pressure when rate falls, or at least doesn't grow at the same pace, is because the labor force is so constricted, right? So it's hard to hire people, it's hard to run hotels really profitably over the years, and as a result, it becomes even harder now. So I get that. Is it a crisis if ADR drops 3-4%? No, but it's tighter for many hotels, especially if you're not in a new hot brand or in the right location, say Marina Bay or other areas. Orchard has started to improve a little bit now at least. Thailand, no doubt 25 was disappointing, even though we said last year that it was going to slow down, but maybe Q2 and into Q3 was even worse, right? So Phuket. Now you have the Chinese missing, yes, and other demand factors as well. So you added a lot of new supply. I still feel good, reasonably good about Thailand long term for sure, but 25 is a year where growth was negative more than you expect, which means 26 year over year, fine, but actual numbers have taken a hit in a number of hotels, even though they hold rate pretty well. And then Malaysia, it was an interesting market for 12 to 18 months. We saw growth for the first time in a long time, outside Langkawi, in more new markets that needed to grow. And that's been interesting, new hotels and growth. And it's come that way, a long way, and now it's about defense. They need to prove that they have the profitability to sustain this, and the productivity, I should say, as well. But I want to talk about Indonesia. Indonesia is a great example, similar to India, where new exciting markets get new hotels, and that's cool. But it's a rocky road. It's not going to go like this. It's going to be a little bit here. You add this new brand, and like, how does the market react, and the demand sources from OTAs and brand websites. But the supply growth, we're helped by this slowing down, right? So we're not having heavy construction. So under construction is slowing down in the last year, which helps. Obviously, you compete with fewer hotels. Good morning, Lada. So we have all this going on. What do we have in Bali? About 2,500 rooms that are coming in Jimbaran and Ubud, and then some scattered hotels elsewhere. It's okay. I think Bali can deal with that new supply. It's not a crisis in the next couple of years. And overall, on Indonesia, That is a very telling story that will break down for you around the country, just that pressure on demand, right? And that's why everyone told me it's absolutely, the world is falling down. But the rate growth is still there. Now, if I adjust that for inflation, the only thing that happens is that the peak drops down. It's not a huge issue now that we're seeing, like the interest rates and that, so, and the inflation pressure is not too bad now. But it's also true that this happened across all the classes. So the rate growth is coming down. That's part of why people are saying, ooh, this is a real problem now. Demand is one thing, and then you have 10% and then 5%. We're starting to see that slow down the growth. So what about occupancy? So if you take the long term across all these squiggly lines, then that thing in the middle we don't care about. So let's remove that. Those 2-3 years don't exist. We have the same occupancy across these markets, broadly speaking. Manav opened with this yesterday and said 2014 to 24, it's kind of the same. Tons of factors to weigh that in to make it a really fair comparison, absolutely. We've added supply, we've added more data around the countries, but we end up with same occupancy. What that means is when you revenue manage, when you asset manage, it's kind of predictable for the next couple of years as well. Are we going to see tons of new, like 5-10% growth? No, we will not. And if you look at the growth perspective, like if you remove Bali and Jakarta where we had more movements, it's just been still, right? The last year is just not moving. It's just sitting there quietly, not really growing quickly. It's just a little bit on the rate side. So let's move around quickly around the country. The theme, 2 things. The first thing is, of course, new hotels, reinventing markets. That's great. Across Sumatra, we're seeing new hotels, not just these great Mentawai and surf resorts, but we're seeing new hotels that are coming. People are interested in investing, and that is great. And on the second point is the occupancy pressure. That's in Riau, so Bintang Batam, Bandar Lampung, Bangka Belitung, apart like in a vast geography. Medan Palembang doing a little bit better, and the only ADR issue is up north in Aceh, but otherwise it's holding up reasonably well with rates and growing some. West Java outside Jakarta, same thing. Bogor, like 12 to 15%. It's been a tough year. It's been a tough year. We know why, so we don't have to go into it. And it's about, has that stopped? We're starting to see that negative growth on a weekly basis, where on the midweek, that has started to hold up a little bit better. And then I look at Tangerang, so seeing ADR growth. People go, oh, what's happening? It was due. It was overdue, and it follows a general trend, so it's not a huge story. Moving up to Jakarta a little bit, I think if you look at a heat map, the more green it is, the higher the occupancy in this case, the higher the rate here. At the end of the day, CBD hotels, the high-end hotels, most bang for your buck, for sure, right? Those are the hotels, they've been able to hold rate. We didn't always see that in Jakarta, so that's something that is helping the market for sure. But let's move over to Central Java, maybe my favorite part of this country. Same pressures, 5-10%. Semarang is growing faster. It's the same story as Tangerang, but in occupancy, low base. So let's track that till the end of the year if they can go against the grain and grow more. But we're seeing similar across these small resorts that are up in the mountains as well. And then move over to East Java where, I love Malang. I had the opportunity to go there for the first time in the last year. Really liked it. But they're struggling more in occupancy pressure. It's again a story of a market that is quite new. Getting some new hotels, having a broad from economy to luxury, not just old and domestic hotels, but also some brands. And that helps the market overall. But if your rate growth is 4 or 5% and occupancy is under pressure, it's going to take a toll, and that's the story around. East and east and east, so this vast area, the last piece, which is, so big that I'm bundling, which is not fair. And it's not, this rate growth is not in say, Papua or something. It is in Nusa Tenggara, which is so big. And when you add a couple of new upper upscale hotels, that impacts the market straight away. And it just looks like something happened. Yes, we're broadening the market, the offering, and that's a good thing. But again, it's a bit of a rocky road around that. And I think East, otherwise, is that the occupancy pressure, the 5, 10, 15%, is less out East at least because of overall demand. But let's finish up with Bali. So if Ubud has lower ADR growth and higher occupancy growth, is it changing? No, it still has the highest RevPAR here, and obviously with the market composition. People still like Ubud, they're coming there, and down south here, so higher RevPAR there. And the only change I saw, which was interesting, and there is some silver lining, there's some good news. When I look at these in the last few years and months, however I twisted, which market, even including East Java Regional, Sanur has taken share. Now, have they taken share of someone else? Now, if you look at what's happened just north of here in the hotels that have opened, it's interesting to see that orange line at the top. We have not seen that before. They take shares. I go, ooh, is it on account of rate? Not really, because if I put this in and look at the same thing, it's still orange, Sanur. They've just taken share. They've just taken more share from either new travelers, incremental, or from other hotels. So Sanur is the highlight in Bali at the moment, which was good. Because not much movement. Like, if it moves up and down, it's occupancy. Left to right is rate. Not much movement. Did you even see them move? It was a slight ADR growth. That's the reality in which you operate. It's not going to grow by much in the next 18 months from now either. Peak season here. In June, people were worried. Peak season came and it went, and it still had some rate growth in Bali, yes, but not for everyone. That depends on that. So when I look into the future, so look at the business on the books. I care less about 365 days out. Maybe Sydney, it's interesting, in Delhi. But if you're in 1 or 2% compared to same time last year growth, it's shorter booking windows, so it matters less. I think 90 days is more interesting. And that's when you see that the pressure will remain on Bangkok and Phuket, and Tokyo will slow down. Won't really affect the rate too much, though. But then Jakarta and Bali, 1, 2, 3%, bigger occupancy on the books compared to last year. So that's a good thing. So this is tiny. Now, again, the booking windows are short, so let's see how that paces. But for Bali, almost 3% more on the books than last year is not bad. And you'll need it, because profitability is impacted everywhere. So if the labor cost per available room was declining, that would be great, but the revenues declined even further. And we dipped below the line. So after 12 months of staying above, seeing positive growth, it was just too much for many of your balance sheets, and the flow-through was not as positive. Bali held up a little bit better, both on account of the productivity, but mostly with that rate growth for those 18 months where it really spun off, including the last two peak seasons. So top markets have seen margin pressure for sure, profit margins down by 3-4% across the top markets. And it's hard in the last few weeks when we released because if you go to a car rental shop and you bring your family and like, I booked this car and you get this, like, that's tough. And when we downgrade around the world now, our forecast, people get disappointed. But I'd rather be realistic and look at what it is. So when we forecast 25 across our Asia-Pacific markets that we do this forecast on, it's going to grow by a whopping nothing, right? That's it's a bit like a deflated statement, because we used to be able to say, like, it's 5% this. It's flat, right, for this year. And we hope there would be a couple of percentage points earlier. Next year, 2.5, right? Why? Well, it's not just the Chinese economy, but it is a regional slowdown. You can look at airlift, you can look at flights, you look at the overall demand. Macro level, talk to me later about your markets, absolutely. But generally, slowdown brings this down in the morning. You don't want that deflated message. But there is a couple of, so you go, whoa, but wait, China, it's going to come back when we get more flights. To Indonesia, I don't think so, right? Because you can look at this on the seat capacity. You see Japan, Thailand, Singapore, Malaysia has more than historic, and the growth has stopped. Whereas Indonesia, you have the same amount of seat capacity as the US, right? China and US, not friends, and you're not, So let's forget about that for a while. But I suppose it's moving in the right direction. So you're playing a percentage game or an actual numbers game. 40% negative last year in our forecast, and next year only a quarter. So it's moving in the right direction. And also the scale there is smaller, right? So smaller and means a little bit more positive growth year over year. And that is very low numbers, like 1 to 2% across APAC. That's what we're saying there. And when you move even further out, by 27, 28, we will start seeing a new investment, new plans, new openings. So then the supply pressure comes back in. And if you look at the planning stages of Bali, that is true here as well. So you make sure that the productivity is working. So if you want to connect with me and get the slides, you can scan that as I wrap up. But please, I attended FIST, so the Sustainability Conference in Phuket on Monday. Please don't forget what really matters here. Bali is an amazing destination. Please preserve the cultural values, the sustainability efforts, all the rubbish and the water scarcity issues that this island has. Never forget that when you develop and work with hotels here. It's so important for the long-term success. We rebalance, as in Japan, growing a little bit slower. That stability in 26 is really just kind of like Australia, but can you deal with it everywhere? That you have 1-2% top-line growth? Is your productivity there? Are you outsourcing when you should or not, your F&B? Is your MICE picking up? But it's also, I like the fact that Indonesia keeps investing in getting these new destinations. We're getting new hotels across markets. That's important long term. So a little bit of pain now, long term you'll see some great hotels. And I also like to see that the productivity is much better now in Indonesian hotels than they were 5 and 10 years ago. And that's impressive. And you right now have a window with limited new supply. So I said this last year, percentage game, or is it that you have, listen, are you focusing on year-over-year growth or what your actuals are? I think Indonesian hoteliers and asset managers are finding themselves now going, like, I should really look at, is this the new norm? Where should I be? Because the next couple of years, you're not going to see massive changes and swings in majority of these markets. And that's before we talk about any geopolitical or geological events in this market. But if I miss any markets on that, on the headline, please let me know. I'm here throughout the day. Thank you very much.